Unlocking the secrets of successful real estate investment starts with mastering the art of property selection. Financial readiness is your first checkpoint. A minimum 20% down payment is often the entry ticket. But what about risks? They're inevitable. But with strategic planning, you can mitigate them. Tools like quantitative risk analysis are your allies here, quantifying uncertainties to inform your decisions. Now, let's demystify some terms. Due diligence is your all-encompassing property appraisal, covering legal and financial aspects. Risk mitigation strategies could be as simple as diversifying your property portfolio. And don't underestimate the impact of natural disasters. They can inflate your insurance costs and eat into your return on investment. To sum it up, effective property selection is a trifecta of financial acumen, risk assessment, and meticulous due diligence. And never forget, location is your golden rule. This segment is your compass in navigating the intricate landscape of property selection, a must-have skill for every real estate investor. Crystal, how do you conduct risk assessment for real estate? And do you have tools that you find indispensable?
Well, I would say your most valuable tools are other people, the people that you lean on. A lot of people don't realize that this is also a systematized thing. Like a lot of us on the call, I'm pretty sure we no longer get in the weeds of, this property, that property. By the time it comes to us, someone on our team in our system has done, a lot of the due diligence for us. And another important point is your network is your net worth. So I like what Dustin said about, asking the property manager, hey, is this a good neighborhood? Is this a good property? You really have to lean on the people who know a lot more than you do. So that's what I do. I lean on the right people, the right team. When I was first getting started, I would attend these real estate meetings once a month. And once a month, it was a round table. And so people would talk about, hey, I bought this property for like $45,000. I used this contractor, and this is how much we spent on the kitchen, on the bathroom. Like they went line by line of how much they spent. And then they said, okay, now I use this lender to refinance. And this is the amount we refinanced it for. This is the rate we received. And then they said, hey, this is who we use to rent it out. And this is the rent that we're collecting. That kind of information is gold, and you're hearing it from the horse's mouth. And how did I get that information? Surrounding myself with people who were doing the things that I wanted to do. So your due diligence is in leaning on people who are doing the things, and they can give you raw data and numbers. Not a guru that's selling you this, inflated lifestyle. No, we want the normal people, the regular people who are not in it for the money or to sell you something. We are in it for the people who want to share their stories. Just share the numbers and share the good, the bad, and the ugly, because we know that these are not smooth processes. There's a lot of ugly also. So you want to be on a comfort zone where you can, ask people those kind of questions too.
Rich, I think that you started with like smaller properties. I guess I think they were single family homes that you could pay for in cash, but then you did eventually, use some leverage, borrowed money to buy some multifamilies. And I think it goes back to this discussion about having a team, in having a network, having people that you know.
Right. Yeah, I think in my case, that decision, well, I think I started off as like, maybe this is great. Like maybe I don't ever need to have mortgages on properties. Maybe that's this, a way to get rich and to have no risk. I think what I realized is I sort of did the math and looked back over time and kind of ran numbers and stuff. Okay, it's really cool that I got up to this amount of properties, but had I done all that responsibly with leverage, I'd be way better off today. Like I did that math and realized that was the case for me. And so it's kind of like, well, okay, well then let's start using debt in a way that I'm comfortable with, and you can leverage to the hilt, or you can leverage responsibly. And that's kind of something that just has to do with your own personal risk tolerance. Now, for me, when COVID hit, I had a 6-plex and a 4-plex that I had loans on, but I had 20 paid off properties. So I think for a lot of real estate investors, who thought maybe for a few weeks or months that maybe they'd never get rent again, they're kind of thinking maybe I'm ruined. I remember thinking like, man, if I never get rent again, I'm going to be really annoyed. So, I mean, it's kind of a maybe better able to sleep at night, but at the same time, when you're able to sleep better at night, you lose the risks of leverage where you grow faster and make more money. So there's just sort of a balance there that everybody has to realize for themselves.
By the way, your timing on when you decided to start borrowing, your timing was excellent, because I think you locked in at very low rates.
That's true.
Which are much lower than where they are right now.
Yeah, Andy. I also bought a personal house at that point, right? A personal residence, VA loan that was, like kind of the big fancy forever home type thing. And it ended up being good timing. It did. Yeah. But I think to Crystal's point earlier, what Crystal said was very important in today's market. And that is, I think a lot of people have only known, these low interest rates, have only known that. And now there's this like, I'm not going to buy a house at 7%. I'm not going to buy it at 8%. I can't invest now. I'm just going to wait till it goes back down. But when Crystal started, right, it was at 7%, I think. And she ran the numbers and it made sense. And I think everybody needs to think that way. You don't get upset and sort of be like, well, I'm mad because things aren't like they were before, so I'm just going to give up on investing. You take the reality that exists now and see if you can make money in real estate. I don't know if they're going to go back down to 2 or 3% in the next 5 or 10 years. It might not happen. It might happen in a year. I mean, but I'm just going to deal with the rates that exist today and make that decision.
That's great advice. Well, I think for stock investors, no one can say, I didn't buy Amazon when it was below $10, so now I can never own Amazon ever again.
Right.
You have to deal with where you are now, and then, where will things be 10 years from now, 20 years from now?
Oh, Andy, I'll throw out a random fact about me, just for your audience. When I was in college, I got my Series 7, my Series 63, and I worked for Fidelity Investments for a while. So I just thought I'd throw that out there. So I'm a money guru. I'm an investing nerd as well as a real estate nerd.
Eric, your experience as a Facebook software engineer, does that help you when evaluating property? And do you use any tech tools to evaluate risk?
Yeah, great question. I always tell people that I think when you're getting started, especially when you're first starting to look at deals, getting very pro at underwriting and just looking at analyses is huge. What I tell people is identify your market, decide what you want to do. And then within a month or two, you should know it like the back of your hand, what is and what isn't a good deal. I had a mentor early on who was telling me that one of the biggest things is if you know nothing about cars and you see a Lamborghini or a Honda Civic on the street, you're not going to know which one's worth more, right? That's the same thing with real estate. When you first get started, you don't know what is a good deal. So the most important thing is to really shorten that learning curve. In terms of the actual tools that I use nowadays, when I first started, I did write a couple of scripts that would just automate a lot of the process for me, figure out, my cash on cash, which is just a return on the money that you put into the deals. But I found that the software tools, it's good for numbers, but there's always these little qualitative details about properties that you really can't figure out until you go into the photos, you go on Street View, or you actually go to the property in person. So I've leaned away from a lot of those automations and do more of it by hand now. But Andy, do you mind if I ask a question to the rest of the group real quick? This is just something I'm always curious for real estate investors. So we were talking about debt a couple minutes ago, and I'm curious if you guys have a specific amount of liquidity or capital. If you got to that point, maybe it's 5 million or 10 million, would you convert all your debt into all cash purchased assets instead? So for example, let's say right now, I've got 10 units, all of them are in debt. We cash flow around 1,000 a month. But if I got to a point where I had 5 million and I could just buy, say 5 or 6 properties, all cash instead, that's something I would consider. I'm curious for you guys, if there's that turning point and what number you would need to get to.
I can share a little bit about how I got there. And I talked about risk tolerances and goals. So my wife's risk tolerance, when I told her I wanted to quit my job, her risk tolerance was, we have too many loans. We have money. Let's pay off some of these loans because I don't want to have this and I don't want to be worried about money. So my risk tolerance was a lot more, just get a lot more debt because I make money. Like, here's the great thing. Everybody here understands this because I don't pay my mortgage on any of my properties. I don't pay my taxes. I don't pay my insurance. I don't pay my property manager. I don't pay for repairs. I don't pay for any of that stuff. My tenants pay for every bit of that. Now, I also make $250 above that in passive income because it's calculated into the rents before I buy it. Just like if I bought a candy bar for 50 cents and if I could sell it for $1, I would do that all day, every day. But if you didn't have that 50 cents and it took you 25 cents, you borrowed 50 cents, cost you 25 cents, that's 75 cents out of your pocket. Then you can sell it for $1. You're going to make 25 cents. You do that all day. Now, for me, what I realized with real estate investing, I could borrow money and make money at the same time. Now, my risk tolerance is I'm completely fine to go with lots and lots of debt. My wife's not. Now, Eric, well, I'll definitely tell you is I am so glad my wife had me pay off like literally, I think 30 plus properties now. And I've invested in hotels as well and stuff. And so with that, I want to say maybe have like 3 or 4 loans at most. And it's so nice that is so much money coming in passive income, but also we don't want to lose the equity or lose that we have equity that we can tap into. I now have home equity line of credits on my properties, on my primary residence. Access to capital is what we need for this great time. It's going to be really fantastic coming up really, really soon to invest in real estate, but you need to have access to capital. So we have that equity in our houses that we could then pull money out when we need it. At least that's how I and my wife, how we got it to where we are now.
How about you, Rich? You were talking about how you weren't borrowing early on, and looking back, you calculate and you say, oh, maybe I should have.
I really think it's going to depend on your personal situation. But if I think of a situation where I'm pretty well off, so I have the option of being all cash, I feel like if you're well off, you don't have the need to pay off those loans. I guess that's the way I'd look at it. You wouldn't be in a position where if you have a lot of equity and you're making a lot of cash flow and you just have a lot of real estate that has loans on it, there's probably a lot of other things that I would do before I decided to start paying those loans off. Now, if I think that your financial situation is a bit more like, I guess maybe more typical, like the average person that might just have 1 or 2 investment properties, and then maybe you're coming into whatever, you're about to retire and your income's going to be lower and you're definitely not getting rich from rental properties. I think the idea of paying down a primary residence or paying off a rental property could be appealing in that case. But I think that kind of when you understand the power of leverage and you understand the power of real estate and how it makes you money long term in many different ways, including tax savings that come from borrowing that money, I don't see the point in paying it off. But I mean, it's a risk tolerance issue.
Any insights, Crystal, from stacking deeds and talking to a lot of people?
Well, definitely. It is the debt thing. A lot of people are afraid, think debt is a bad word, but there is a difference. This is good debt. You are using debt for leverage to create a income producing, asset. So you're not using debt for dinners out, vacations. You're using it for something that's actually going to produce income. It's going to self-replace. It's an infinite loop here. So this debt, I love the real estate debt because it means that I'm, getting money back. It's replenishing itself. It's self-replenishing, not the debt, but the income. And it's a tax break also for that interest. So, and a depreciation. So that's another phantom word that we love in real estate. So people just hear debt and want to run and scream, but this is not credit card debt for fun. This is income producing debt. So you want debt that is producing income.
I mean, it seems like the choice to pay off debt can translate to sleeping better at night, having a little bit less to worry about. Should where we are in the market cycle dictate how much debt you want to have versus how much you don't want to have? Or is it like long-term investing in stocks where if you're trying to buy at the right prices and you've done the work ahead of time, that it's a long-term plan and you're sticking with it regardless of the economy?
Just as an example, unlike the realtor side of things, I have a couple of investors who are going all cash these days. And to Dustin's point, they're pulling HELOCs out on a bunch of these properties. So they still have access to that capital, but it's more a question of, do they want to pay the interest on it right now versus sometime in the future? And I think that's made sense for a good number of people so far, where it's like, right now, interest rates are pretty brutal. If you do have access to capital to own things cash, and at the same time, you can still have access to that line of credit, it works out nicely for you.
Good
I
insight.
personally like that. Like I was saying, I don't pay the tax, or sorry, the interest, like the principal and the interest. If I buy a house that, I buy it for $200,000, put it down a down payment, well, the balance of that principal is paid by the tenants, and the interest is paid by the tenants. The taxes, everything's paid by the tenants. The great thing about this is, whether the market goes up, whether the market goes down or sideways, we make money because we invest in passive income. Now, I personally don't mind using debt. In fact, I love utilizing debt because it makes me money. And on top of that, what I love, because interest rates, even though interest rates are high, because people are really concerned. Oh man, interest rates are very, very high. I can't buy this property. And I completely understand. Well, if you're going to be, as I'm talking to my students, what I usually tell them is, if the price is too high and the interest rate's too high that you're not going to be making any money, we don't buy the property. We don't go through with it. What we do, though, is we offer lower until it makes it work for us in passive income. So we have to lower our purchase price. Now, it's a lot harder, especially when prices are still pretty high. Interest rates are really high. But the biggest thing is, as long and I think Eric mentioned this, it's every single deal is going to be different. And so it depends on the deal itself, meaning the property. If you buy the property for the right price, that you have the expenses accounted for, that you could rent it for, in my opinion, suggest $250 or more in passive income. If you're able to do that, it doesn't matter what interest rate, it doesn't matter what price you pay, because like I started investing back in 2006, and in the crash, 2008, I was worried about that crash. Like, oh my goodness, our rent's going to come down. In fact, they did not. They actually went up, because sadly, if their market changes, sadly, people are going to lose their homes and they're going to go to foreclosure. Well, that pool of renters goes up because demand is higher now. My rents just keep going up. So over time, rents go up. Over time, prices will eventually stabilize. So in my opinion, if you utilize interest and do it right by building the business, making sure you have your expenses accounted for, then you're going to be successful. If the market goes up, down, or sideways, you'll still be making money.
I like that. Okay, we're going to go to segment 3.